Hello and welcome back to Dukascopy TV. In its latest policy decision, Canada's central bank kept its benchmark interest rate steady at 1%. This is for the 21st consecutive policy meeting despite a dampening economic outlook. To give me his insights into this decision, I'm joined down the line by Erin Weir, Research Associate at United Steelworkers Union. Erin, was the decision today what you expected?
Yes, the Bank of Canada has maintained a target interest rate of 1% for the past 4 years. The only reason to raise the interest rate target would be to curtail inflation, but inflation is running at only 1.2%, which is below the central bank's own 2% inflation target.
The total job vacancies for Canada in January was down by 22,000 from a year earlier. So does this dismiss government and business arguments that Canada is facing a serious skills and labour shortage?
I agree that yesterday's figures cast doubt on this notion that Canada is suffering from a labour shortage. The total number of job vacancies declined to 200,000, which is the lowest on record since Statistics Canada started keeping these figures in 2011. We now have 6.5 unemployed workers in Canada for every job vacancy. So I don't think there's much evidence of a labour shortage.
One argument Mark Carney gave to raise the central bank's 1% policy interest rate would be if the housing boom is slowing. Now, existing home sales rose 2.4% in March, so is the boom really about to go bust?
It's true that existing home sales rose 2.4% compared to the previous month, but they were down 15% compared to a year ago. So I do see the housing boom slowing. Raising interest rates might further slow down the boom by reining in mortgage lending. The problem is that higher interest rates would also adversely affect other sectors of the economy. If Canadian policymakers do want to moderate mortgage lending, they have other options. For example, the Government of Canada provides much of the country's mortgage insurance and can quite directly moderate the sector through that channel.
Is weak global demand hurting investment and exports from Canada?
Certainly Canada has been hurt by weak global demand. Historically, Canada has been an exporting country that benefited from a significant trade surplus. More recently, Canada has suffered from a trade deficit, so there's no question the country has been hurt by external factors, but I wouldn't put all the blame outside our borders. Our own federal government and many of our provincial governments are pursuing austerity policies that are also slowing our economy.
The outlook for Canada's economy has weakened significantly in the past few months, falling further behind the United States. What do you see for Canada's growth for the rest of this year?
I'm not in the forecasting business, but today the Bank of Canada projected economic growth of only 1.5% in 2013, followed by growth of closer to 3% in 2014 and 2015. I believe the central bank is correct to expect a weak economy this year, and I hope that the Bank of Canada is correct in anticipating somewhat stronger growth in the future.
That was Erin Weir from United Steelworkers Union on Canada's latest rate decision. I will be back tomorrow with the day's top headline in the form of a Dukascopy press review. Take care.